I question whether college is actually the value proposition that everybody thinks it is. Culture is going to happen whether you manage it or not. And I think it's better to manage it because you want it to be what you want it to be, not just happen. I don't like the idea of an IPO being your goal. I think the goal should be increasing value. And if you ultimately are able to increase value and it intersects with the market at the time where that is highly valued, then it's a good time to take an exit. And if you're prepared, it looks like you're organized. It looks like you're in control. And if you're scurrying around trying to get it, then you look out of control. You need to use time to your advantage. And so the sooner you can get some people involved, I know it seems expensive to the business owner, but it's an investment. It's not an expense.
Climbing up is a struggle, tension in the air. But the underdog prevails, we here to declare. To the top or the mountain where champions stand. Failures can't break us, we taking command. Yeah, it's a journey, climb to the peak. Scaling businesses, who it ain't for the weak. Growth is the game, we play it real tall. From the bottom to the summit, we rise, never fall. Interview the legends, success stories told. Risepreneurs, hearts made of gold. Strategies unfold, in the struggle grace. Hardship and challenges, yeah, we still embrace.
Welcome back, everyone, to another episode of the Risepreneur Podcast, a show dedicated to all the entrepreneurs and business owners out there who's looking to scale, grow their businesses, and ultimately exit at highest valuations. Today, we have a special guest. His name is John duHadway. He's a senior entrepreneur and investor coming to us with over 30 years of experience. He exited as a co-founder. He had 4 successful exits, ranging from 50 million to 2.5 billion. He also a founder of duHadway LLC, which provides fractional C-suite support to all the business owners who's looking to have leadership in place. John, say hi, and we'll begin.
Hi, great. Thanks for having me here.
Thank you. So, John, can we go in time a little and touch on, were you always entrepreneurial, or that's something that happened along the way?
Great question. And we have a lot of time we can go back. I'm getting pretty old. I think I've always been on the entrepreneurial side. I can remember as a kid working and doing just odd jobs and hustling around the neighborhood, trying to make some money. And then through college, I got indoctrinated into more of a formal professional services. And that kind of, I don't want to say stifled it, but it overcame my entrepreneurial abilities at the time. And then on the back end, when I left public accounting, I again got into corporate world. And at that point in time, I flourished again on my entrepreneur side.
Was there a reason you pursued college if you were entrepreneurial from earlier days?
Actually, quite funny. The long story is, no, I wasn't actually going to go to college. I was raised with a single parent mother and was economically challenged and didn't have much to participate with my social network and so forth. And so I found I was working to make some money to keep up with the friends and so forth and be able to participate. It wasn't until I was pretty much graduated from high school that I decided to go to college. And it was more about me feeling at the time that I was getting left out, that everybody else was going to college and that I was getting left behind. I'm glad that I did, but I was very close to not going to college.
Reason I'm asking, I have 7 kids. And we have constant debates, go, not to go. And I kind of made my way without going to college, but I also have a lot of guests on the show that went to college, some under peer pressure, some under feeling left out, right? So I'm just wondering what it was for you and if you see a value from going through that experience.
Yes, it was a different time. And so I think at that time it was the right choice for me. But I think in today's world, I would, especially if I had 7 kids, I would question whether, I have 2, I question whether college is actually the value proposition that everybody thinks it is.
Awesome. So John, would you also say that being in Deloitte and other entities in corporate world, taking position of a CFO on a financial side, kind of didn't springboard, but gave you that strength of looking at numbers and making decisions for numbers and pursue and have your successes because you were familiar with numbers?
I think so. I think it enabled me to, when I started at Deloitte, what happened was it gave me an entree to be able to get exposure to larger organizations. So this was not necessarily the small mom and pop kind of companies. These are large Fortune 100 companies. And so at a very early age in my professional career and without a lot of experience, I was getting exposure to very high level executives, and I was able to see how corporate America was run. I was also able to use accounting and finance. Was actually a good way for me to learn the way the business worked. We would work through the business model, and I could really see from all perspectives from the beginning to the end of whatever the product or service was that they had, how it worked. And I think my advice still is, I think accounting and finance is a great fundamental for anybody wanting to be in business because of that. So I'm very thankful for that. I do see a lot of other people being successful without it, but for me, it was a way for me to really get a baseline and understand how just fundamentally the business work.
Awesome. Thank you for sharing that. Can we really go high level through your 4 exits as a co-founder? What type of businesses those were? How did you get started with those, and what the exit looked like? And then I'll ask you deeper questions on each one.
Sure. My exit from public accounting, I was a point in time where, well, backing up, I felt like I was going to stay at that time. I was becoming a partner, and it was becoming more entrepreneurial for me at that time. But the market changed a lot. Back then, there was Enron and a couple other crises that happened, and I felt that the compensation and risk were being inverted, being a partner within an accounting firm. So I started to look, or I shouldn't say look, I opened my ears. I had never really listened before. And so I was introduced to a man who ultimately was a partner of mine in business, and he was extremely entrepreneur, probably one of the most entrepreneur people I've ever met. I joined him because he had a company that he had already sold, and he was buying it back. He was buying it back from DLJ Merchant Banking. And so it was about a $30 million acquisition, and we partnered with a private equity firm to acquire it. I was brought in as the CFO, and then we built that up and we sold that, and we actually sold it multiple times. And so that was my first experience as being an owner and selling a company. I had done it in public accounting for other people, but it was extremely rewarding. I did it there, and then I did it with a technology company. After the second time we sold it, we had a non-compete. During that non-compete, this was in a lending business, to answer your question. I had the non-compete. What I did is I went into the technology area, and it was a company that was it was a lead generation type of company. And I was fortunate enough to get in on the ground floor there and was able to bring that to a strategic sale. And so we sold that, and that was, I'm going to say, about a 50 million sale. And the timing was very apropos and very perfect in a lot of ways, because my former partner then called me and said, "Hey, our non-compete's up. Do you want to do it again?" And so we did the same thing again. We went and bought a platform in the lending business, and then again, acquired that using some private equity funds to help us, and put that and sold that about a year and a half later. And again, that was in the same size. It was about 30 million at the time when we bought it. So those are probably the big ones I've had. And I've had a couple other smaller ones more on the private equity side where I invested small amounts. And in a couple of cases, I stepped in the management roles, but most of the cases it was passive needs.
Awesome. Thank you. If we look at the company before going out and like exiting, when you bought it, was there like a specific blueprint you followed? I know every business is different, right? But was there like, okay, let's look at the vision first, let's look at the culture, or let's look at our product, how can we enhance the product? Let's look at the marketing, let's look at the lifetime value, like where the focus would be initially when you would acquire a company? Is there a specific set of tools, systems that you use to guide yourself and your team?
Yeah, the first one was more me learning, right? I came from public accounting thinking I knew everything. Like I said, I learned a lot by being able to see how companies work. And I advised a lot of clients at the time, but I never actually did it. And in this case, we were changing the product, and it was in the lending space. And it was really aligning what was in the marketplace, like what was the market need, what was available in the market, and what were customers looking for, and so forth. Again, it was lending. So we were, not to get too specific, but happy to, but we were doing what was considered to be alternative type lending for consumers. And so this was at a time when the governmental agencies were doing what's called A paper lending. The A paper was a commodity, and there was a lot of it, but it was a scale type business, a low margin, very scale. And so we found that being just outside that, what happens if a borrower just misses being vanilla A paper loan? There was a lot more margin and a lot less competition for that. So that's what we wanted to do. The company that my partner had, DLJ, just felt that that was a different business. It wasn't a different product. And we tried to convince them that no, that it's the same processes and so forth. It's just a different type of product. They continued to say no. We found the only way that he would be able to accomplish it would be to buy the company back. And so found a capital partner that our concept resonated with and could see in the marketplace how that was happening. And they helped us, funded us. And so then we came in, and at that point in time, we had to retrain, particularly our salespeople, on selling the product. And so we had to discontinue one product and start another product, which on paper sounds easy, but it's very challenging because you get involved with compensation models and things like that that drive the sales folks. But we were able to do that. We also introduced options. At the time, stock options were really just a tech type of thing. We had that for every employee throughout the organization. And one of the things that I didn't know at first was the whole value of core values, mission, and vision. And I came at it from being in public accounting, and we spent a lot of time on that. And we spent a lot of time bringing the team together, which was nationwide. And it wasn't until we exited that I realized that I had a bank that was buying us, and they went down the P&L and they scratched the line that was, we had an annual meeting that we'd bring everybody in. It was a very large number, and they felt that that was a way to save money. And I as a CFO was arguing that, no, that's really, very well spent amount of money because it brought the culture together, got everybody aligned on values, got the vision, people could drink the Kool-Aid and understand exactly what we were doing. Extremely powerful. It's not something that shows up on the balance sheet as an asset, but I walked away from when we sold that to that's what I focus on now. I really look to see that a company can articulate what their vision is. How are they getting their employees aligned with that? How are they creating a culture? Culture is going to happen whether you manage it or not. And I think it's better to manage it because you want it to be what you want it to be, not just happen. And so I really spend a lot of time with entrepreneurs now trying to help them not only articulate it, but then how do you reinforce it? How do you get people to buy into that? Because again, I saw the power of that. We had people that would run through the wall for us, and it had nothing to do with compensation. It was all about being aligned, and we were aligned from top to bottom.
Every single company of those were focusing on national. It was national company. It was not in a specific area.
They all were national. When they started, the second one that I had done was primarily focused on the West Coast. And then we brought it in and added more.
Yeah, the reason I'm asking, did you have multiple locations? So it was out of one specific office, or everything was remote?
It was like a hub and spoke. We had offices throughout the country. And then, so like the largest one probably had, I'm guessing now, is probably about 30 offices nationwide. We were headquartered out here in California. And then each of those offices might have satellite executive or, this is pre-pandemic. Everybody believed in having offices at the time. Nobody really worked from home, but we had sales teams that would work remotely. But again, it was about 30 or so offices nationwide, all rolling up into the mothership, which was in California.
So when you bought into those, was there some kind of culture was in place, I would assume, of being that caliber of company? It was aligned when you came in with your co-founders, with your values?
Well, it was quite different. I'll give you a really easy example. We walked in and they had a little soda machine, and they required, and again, we're talking about a corporate headquarters that had maybe 50 people, and they were the neural net, the nucleus of the company. And so there was a little fountain distribution like you would do at any fast food. You go up and get, but the employees had to pay. It was like a quarter. And so we looked at it and we said, yeah, get rid of that. That was like that simple little gesture, which probably cost us $50 a month or something like that. It just reverberated through the organization. The point was we wanted to make sure employees knew we value, it's a people business. So we wanted to make sure they knew we valued them. And, this was a very small thing. And the prior owner was the opposite. He was counting pennies, and we felt that this is just a courtesy. It's just, these are people that are doing a lot for us. And I wouldn't say that we were lavish, but we also realized that there's some basic things that we can do to really make employees feel rewarded and valued. Yeah, it was quite different. It was very hierarchical. It was very dominated from the top. It was very, provincial. People were kept in their own lanes and so forth. And we brought in more of a collaborative, we're all in together. The executive team wouldn't eat lunch and things like that with other people. We did the exact opposite. That's what we wanted to do. We would sit down and chat with them and so forth. And so it really broke down a lot of the barriers.
Awesome. Is there top 4 or 5 core values that, besides talking to you, would talk to pretty much majority of people in the organization that you can share? Like, sounds one is to collaborate, right? It's a team, being as a team, showing empathy, kindness. Like any other that you would say, like every company that I would go to, I would insist on embracing and following values.
Yeah. I mean, I always say it's core values, right? There's a lot of values and it's core values. And I think keeping them kind of focused, and I think I don't want to say they're unique, but everybody has their own kind of blend of them. We were always fighting for the underdog, David versus Goliath. If you didn't understand us, it might sound, I don't want to say offensive, but different. Like we had one of our taglines was, we play by different rules. And as a CFO, when we came up with that, I was like, I'm not sure I like, and my partner, he was, like I said, very entrepreneur. He said, John, it doesn't mean we don't play by rules. It just means we play by different rules. And I was able to understand at that point in time, and I embraced it as well, which was, I don't want to say the renegade, but we were definitely innovators. We were trying to change the old and bring in something that made more sense. We had a lot of just sayings that we would say, like we were in the lending business, and we said, the rules were made back in the 1960s by a bunch of fat white guys sitting in a conference room. At the time, that was the demographic of America, but America's changed, and we need to change, and we need to have the rules change. How do we handle families that now are immigrating, but also multi-generational, living within one house, which was not heard of in the 60s. In the 60s, it was the nuclear family. It was husband and wife and 2 kids. Well, now you have, so which one is on title? Which one's going to be borrowing the money? And so we had to have different rules to kind of, properly underwrite the product, but also to make it easier for those types of people to be able to get financing. And so we were really championing at the time. And that just goes to the core. We were trying to find different ways to change the process.
Mm-hmm, mm-hmm. I see how embracing underdogs, that's majority of the company, right? Majority of the team. So you would have a lot more buy-in into that idea. So how did the leadership react, since they got used to the other way around, right? I don't know if they embraced it right away or there was some resistance.
There was a little resistance. We kind of accomplished it by dilution. So what we did was, it was myself and one other executive that was with our team at the prior company, and then my partner who was the founder of the other company. So the 3 of us came in, we brought in our own team, and it wasn't necessarily a takeover. It was just that there's more people sitting at the table. And so if you were, 1/5 of the voice before, you're now 1/10 of the voice now. And so it just diluted it. And through our actions and through our interactions and behavior, one by one, they started to get in line. We had, I want to say maybe one person that didn't, and they didn't last that long. And, they kind of,
that would exit.
They get ejected like a virus.
Yeah. I mean, based on my understanding, it's one of the biggest fears, especially when you having mergers, right? When you're merging one firm with another, just like you shared with the bank, they were looking at it differently. So if perspective is different, minds collide, right? And then who prevails? So you would say that you try to dilute, and then the minority would just eject themselves.
If they didn't, yeah.
If they did not embrace, yeah.
Yeah. And we didn't force it. It was more, hey, we're open. Tell us what you think, but left to our own devices, this is the way we think we should run the company. This is how we're going to do it. This is how we're going to change processes. This is how we're going to reward. This is what we're going to recognize as good and what we're going to recognize as bad. And in most cases, it was uplifting because we came into an environment where management didn't trust the employees. And so the processes were more about the stick versus the carrot. And we were much more carrot driven. We were trying to reward people and not just about people.
Yeah, interesting. Cool stuff. Thank you for sharing. What about the vision, the exit? Since you had multiple exits, and for most of the people, most entrepreneurs, if they get one, all right, it's a major event of a lifetime. So did you have the intention already in place that we're going to exit in 2 years, we're going to exit in 3 years, and based on that, we'll implement a specific strategy. That's what we'll focus first, second, and so on. Or it was, let's go in and just grow the company, and then out of nowhere, somebody gives you an offer, there's a buyer.
Mhm.
How did that work out for you?
So my first one was when I left public accounting, I was recruited by the founder and by the private equity firm. Well, basically it was part of the discussion as, hey, look, here's what we're offering in compensation. And by the way, we're trying to exit this in a 3-year horizon, 3 to 5 year horizon. So it was kind of known. The private equity firm wanted to exit. We were looking at it as not necessarily an exit. We were looking at it as more of a monetization of our value, but we were thinking to stay involved. The reason why is in that business is it was a very capital intensive business. And so you eventually have to get a capital partner. And so we thought that we would exit, get the private equity firm their return that they needed, be bought out by somebody like a bank, and continue to work. First time it was a sale minority interest, and that worked. We did that. But the second time was when it was a 100% sale, and the bank that had come in, it was typical bank. It was very bureaucratic. And by the way, it was a competitive bid offer, but they came in and my business partner leaned over to me at the signing when we were closing at the closing table and said, yeah, you're going to be the first one shot. I'll be right behind you. Don't worry. What happened is they immediately want to get control of accounting and finance. And so it's an example where I was on the other side. They come in and they bring in their own people. They change the reporting, who's reporting whom, and the information flow and so forth. And it was very different. For me, it was the beginning of the end. It was like, I didn't want to be there. I eventually was severed out. My business partner ultimately was severed out. And, we had non-competes as part of that. And we did it again. The second deal I did, which was in the intervening period time, was more of a technology company. And that was a couple engineers from Stanford. I was up in the Bay Area at the time, Silicon Valley, right in the middle of .com. And I think any business that was getting started at the time, people just envisioned selling. So that kind of had the same view that there was going to be an exit, but it wasn't as big. It just wasn't as big of a company. And I got that to a point of a strategic sale. I think a lot of times people think about an IPO, and that's, I always laugh when somebody says that, what's their strategic plan and what's their goal? And their goal is IPO. And I just find that might be a result, but I don't like the idea of an IPO being your goal. I think the goal should be increasing value. And if you ultimately are able to increase value and it intersects with the market at the time where that is highly valued, then it's a good time to take an exit. But that exit could sometimes be better going the strategic sale path. And so in this case, we sold to a party that was trying to get into the business, and they gave them an offer. And yeah, it's not as sexy as doing an IPO, but cash-wise, it was as good, if not better.
So let's go back to each deal. So in each one, okay, let me rephrase the question. Is it pretty common that the back office is the first one to be potentially wiped out when a new entity acquires and roll you up into their own world, kind of? Or it's not necessarily so, and it could be that they would let the back office continue as it was?
Yeah. No, I don't think it's one way. I think in my case, these were regulated businesses, and banks are very compliant oriented and very regulated. And they want to have the purse strings and the heartbeat kept close to the bank. And so they don't have the issue of having the salespeople running around and trying to sell loans. They would even get involved in the underwriting of the loans and so forth. But the first thing they want to get control of is the financial side. And I don't look at that as a negative. I think I can see it from their perspective. But then I had another, like I said, the other one, which was not a regulated business, very unregulated. And I left, but I left because once I was able to monetize the equity I had, I was going to do this other deal, put the band back together again and do it again. But for the most part, the office stayed intact. So I wouldn't want to scare people and make them think that that is necessarily what's going to happen. I think it really depends on the business and the industry. Is it something that can be replicated elsewhere? Is it something that is duplicative with what they have, the acquirer? Are they two different businesses? I mean, I think there's a lot of things that go into that, but I've had both.
So for that, the transition period is pretty common, right? And I guess a smaller business, and also probably on the intentions of the seller, they might look to exit right away, or sometimes they stay as a C exec to continue to oversee that. Besides the one where you were pressured to leave because you started to pick up that new venture again in the same space, the other one because they forced you out. Did you intend to stay and minimize the responsibility, like tax responsibilities? Is there a way to, what I'm looking for is what in your experience, based on your exits and based on the exits that you had when you were passive and over, you saw a bunch of deals happen. Is there a way to more or less structure a deal or look into certain structures where you would minimize the expense besides legal or the accounting during due diligence and so on? Is there a way to transition a business? Maybe stay there, maybe have an earn out at some point? Like, how would you, in your experience, see not a perfect play setup, but if you would explore this option and structure it approximately that way, and again, details you talk to your
Sure.
accountant and so on, do you see like a pattern of structuring it?
Yeah, I think, it starts with due diligence. And so the acquirer typically will come in and do due diligence. And part of that due diligence is trying to understand who are the key people. What they don't want to do is write a check and then have you leave and be stuck holding a company that they don't know how to run. So they want to keep you on. And there's a commitment. I want to say it was a 2-year deal where I was essentially locked in. So you're an indentured slave for 2 years. And part of that, so you're negotiating for the company, but you're also negotiating for yourself personally. They say, hey, we need to lock you up. We need a 2-year deal with you. So now you're negotiating with them on your personal deal. And at the same time, you're negotiating on behalf of the company for how the company is going to sell. And so you end up, as part of the deal closing, is signing on and saying, I'm going to sign into this employment agreement that's going to lock me in here for 2 years. And I'm going to expect X dollars in base, and they'll give me some equity, and they'll give you incentives to keep you there. But after that, they could terminate you beforehand, but they have to pay you. I think that's normal. That's fairly standard. And particularly at the executive level, they want to lock you in. They're fearful of what they don't know. And if they come in and they find out that they overestimated what you do and you're of no value, then they'll probably look to negotiate to get you out of there. On the other hand, if you're showing that you're extremely valuable, they're going to want to sign you up and layer in more equity and keep you going. And so it kind of depends on the person, I think. But if I've been on the acquirer side too, where I come in and that's exactly what we would do, is we would try to lock up people. And then you say, well, why would you want to do that as executive? Well, I also then can't sell the company because, especially as a CFO, I mean, as a CFO or CEO, if you were to say, no, I'm not signing on, it's kind of a red flag, right? Why would you want to buy a company where they're unwilling to stay on? You don't believe in it. There's some unknown risk or what have you. It's part of the job, right? You know that if you're going to sell it, you're going to have to sign up and hang on and be there. Did that answer your question? And then I guess
Partially. I mean, I'm getting more. I'm getting more questions pop up as you go along. So they try to lock you in, and basically my question, from that is, so of that caliber business, there's still key people. Okay, CFO might be, because on the financial side of things, they might want to keep you. When, like you said, as soon as they see that it's all clean and good, would books be clean of that caliber company, and there should not be any key man in the company? Isn't a huge risk still? I thought such risk exists only on the smaller companies, not of that caliber.
No, well, we obviously are audited and all that. And I don't think there's a concern about the past. I think it's more about, if we go sideways and John just takes the entire team with him, it almost gets into I don't say guerrilla warfare, but they start thinking like the worst thing that could happen. And it's a headline matter too, right? So if they come on board and John leaves, they want to manage that narrative. They don't want to have it be that, John's a whistleblower and left, or worse, I'm valued more than the company and he left. And so why would people want to be doing business with them? But I think those are kind of extremes. I think it's more about they want to have a workforce that's in place. They know that I'm an executive that's managing multiple people. If they can't keep me in the seat, they're not going to be able to, their fear is they're not going to be able to keep the others in the seat, especially if you're espousing this culture that you have that is going to keep people. If you leave, then honestly, that was part of what happened when we left the first company. We were able, after our non-compete was over, we were able to attract people to come to our new company. And that's an example where our value was beyond the 2 years. People still kept in touch with us. We were able to hire the best salespeople. We were bringing the best talent from the corporation over to us. And that's just because of the relationships and how they believed, how we treated people and the type of culture that we created and so forth. They wanted to continue to be part of that. On the flip side, when I was as an employee and it gets sold to a bank, that's what happens is they start to I shouldn't say they kill the culture. It's a different culture. And so they bring in a different culture and it just wasn't something that aligned with me. And so whether I was contractually obligated to stay or not, it's just not something that you'd want to continue to be part of. You'd want to go and put the band back together again.
Probably also in the buyer's interest to tie everybody else to similar agreements. So in case you leave, right, and because you all align on values, for them not to leave, you probably tie your compensation for people to stick around for as long as the transition happens and they're comfortable. Interesting. So going back to the original question, so 2-year transition, do you have a say like, okay, here's how I would want the money to be distributed to me? Right? Or like it's all like everything needs to happen within these 2 years. Do you usually try to take all up front and then deal with all the tax related and expense related challenges afterwards? Some of them probably also covered by the company, right? The due diligence part that's not really tied directly to your compensation.
Yes. So when it's sold, they can't take that value away from you. That value is what their value is as a shareholder. But they can say, hey, we want you to roll over. We want you to take 30% of the proceeds that you would normally get by selling and roll that over and reinvest in the company because we need to show that you're involved.
Yeah.
And if you do that, here's your base compensation. Here's the bonus that you'll get, the structure or what have you. And then maybe here's additional options because resetting it at the new value. So now you get new options. The idea is they want to keep you incentivized. And at the same time, you're not going to take something less. So that's all a negotiation process. If you look at it from the two different ends of the continuum, the one end is I'm cashing out as just like an investor would and give me my money. But on the other end of the continuum is they want to keep you around for indefinitely. So they want to keep you happy. So they have to incentivize you. But the incentivizing is based upon you staying on longer. And so there might be additional options given that vest in the future. And so that's kind of holding that carrot out there further. And in between is all different types of ways and times that you can get out. That's the transition period usually isn't that long. It's usually shorter. And I would say probably in a 6-month time frame, we were pretty much integrated. A lot of it's done prior to the transaction. These are bigger deals. So they would have a transaction team that's dedicated. They came in, they'd have a post-transaction person who was involved in integrating HR matters, all the benefits and so forth. For us and our employees, that was attractive because they were a much bigger company and they were able to give us better benefits. The negative was they were based in a different state. And so their benefits were different than California. But that's usually one of the first pulse points that they're going to touch on is the HR side and then the accounting side. And so the accounting side would be, we would get different ways of getting funded versus us doing it in the open market. We would get funded through the bank for the loans that we were lending and so forth. The accounting would be, not that we were doing accounting wrong. Accounting was proper, but they may have different ways of treating different things. And so you would then be conforming to theirs. And then are you a standalone company? Do you continue to exist or are you just now a subsidiary? those are different matters. In our case, we were a separate subsidiary, but we were 100% owned.
Mm-hmm. Interesting. Would you say that going through the bank has less pressure versus private equity? Because private equity needs to exit at some point. They will pressure you to exit with them potentially. And banks probably would not be as insisting.
Yeah, I mean, I'm going to generalize here, so hopefully your audience doesn't come across. But I would take private equity all day long, and the reason why is I find that they are more energetic, more in tune with the market because they're trying to, like you said, they're trying to exit. So I feel like they understand the market better than the bank. The bank is a behemoth, and they tend to be bureaucratic. It's like dealing with the government, if it's a big bank, especially. And while there's quality people there, they're working within an organization that is just very slow moving. It's the aircraft carrier trying to make a U-turn. It just takes forever. Whereas private equity, a lot of times extremely smart people, very successful people, willing to take chance, willing to take risk. Bank, not willing to take chance, not willing to take risk. So it's, I think, a personal preference, but for me, I would take private equity all day long. They're going to drive you. They're going to make you, the old saying, steel sharpens steel, right? So they're going to force you to, because it's their money and time is money. And so they're going to force you to do what needs to be done.
Yes. Awesome. Also, John, based on the perspective on when you want to exit, the strategy, of course, is different, right? So if somebody's exiting in a year, they're looking at completely different aspects of business. They're probably trying to beautify or trying to make it more appealing to the next buyer, right? Versus like if you have 3 to 5 year exit strategy plan, you would probably focus on different areas. What are the main differences on when you're looking to exit earlier versus at longer pace?
Great question. I would tell people that when you go through an exit, it's like a second job because you're having to go through due diligence. You're trying to market the company, go through due diligence and go through the transaction. And a lot of times that's what I do now as an advisor and consultant in my firm. I'll help smaller businesses prepare and go through that process. Even if they have a CFO, a lot of times it's easier to have the existing CFO stay focused on the day-to-day business and operating the company and have somebody like myself handle the transaction, which is, like I said, a full-time job in itself. So I would caution everybody that it's longer than you think and more invasive than you think. I have a client who just finished raising some money to expand they're regulated. So they expanded into another market and he wants to exit in, 3 to 5 years. And what we've done is we sat down and said, okay, well, who do you think would be the potential buyer of this? And what would be the metrics, if you fast forward, what would be the metrics that they would look at? What's the value? And in this case, it's a real estate industry type business. And so there's orders or files that get processed and the owner is actually doing 70% of the files. And so my comment to him was, we got to get that down to almost nothing because nobody's going to buy it if you're the guy because you're the value. We need the value to be the company. We've set up these metrics so that over time he can track that and we can see how he's driving value by essentially pulling himself out of the business or forcing others to fill the void that he's not doing the production. Somebody else is doing the production. So that's what I would encourage people. And time is an asset that everybody has and everybody doesn't have. And what I mean by that is if you come to me today and you're going to exit tomorrow, there's only so many things we can do. But if you come to me today and you're exit 5 years from now, that's an ally then. Time is your ally. We can do a lot of things between now and then. And I think any reputable advisor would tell you the same thing, whether it's an attorney or whoever. If you give them time, give them some advance notice, there's planning that we can do, there's structuring that we can do to make it most optimal, most beneficial to you. But if you come the day of, it's pretty much, the song's already written. We can't do anything about it.
Yeah. Would you say the minimum would be anywhere between 3 to 6 months in order to find a buyer, go through due diligence, or it might take even longer than that?
I would plan longer. The reason why is you can't control the market. And like I'm seeing that in today's world, I've got people who have certain visions of what value is. And then you have to market the company, you have to find people who are interested in buying it. But then you get into, okay, well, great. Their multiple might be the same, but now you start getting into the composition of that multiple. So if I tell you I'm going to give you 5X, if you got 5X last year, cash on the barrelhead, versus I give you 5X today, but it's in a note, it's holdback, and you get 10% in cash, that's a different value, right? And I think the longer you have, the more opportunity you have to structure that and get that the way you want, and also to take advantage of the market. I would prefer to be opportunistic. And so what I try to advise clients is, even if you're not looking to sell, let's plan on it and let's build value. And if we can build value, somebody's going to come knocking, right? If you're really building value, whether you want to sell or not, you're going to ultimately get people interested, curious, wanting to invest. I think that's a better proposition than trying to say 3 months from now, I'm going to go out in the marketplace and it's maybe not of value or not as much value as I think it is. So I try to get entrepreneurs to focus on value creation. If we can create value, other things will come. That should be our primary focus, create value. And then somebody like myself can help do the window dressing, like I think you were referring to, which is, we always say, dress the bride, get everything ready. That involves due diligence, so making sure all the paperwork and documentation is aligned. And so it makes it very clean. That adds value, but that value won't come until you actually have the exit. But I think the company itself, just again, focus on creating value, and good things happen from that.
Can we mention some of the things which you already touched on? If the leadership, the owner, spending crazy amount of time and things depend on them, one of the values, remove the risk level, right? That's Acumen. We want to remove that business owner from doing day-to-day operations and put him more on the strategic side of things. So that would be one of the values. What are some other values that you can list for someone just to get an idea where else I can look at, right? Introducing values, core values, adopting those core values. What are the things that we didn't mention yet that would be considered as a value, not just to dress up a bride?
Yeah. I mean, we always try to put ourselves in identifying who we thought would be the ideal investor. And in our case, going back to the first exit I had, we felt that the way the market was, the only probable party would be a bank. And so we tried to put ourselves in the position of a bank. What does a bank look for? And as we talked about, a bank is very regulated, very compliant oriented. We were in a business that was regulated, but it didn't have anything of our regulation was basically you had to be licensed. And so you go through that. A bank has the FDIC and all these other federal regulators that are reviewing them all the time. And so what we did was, in our business, there was no compliance officer. At the time, in our business, there was no compliance officer. We created a position called compliance officer. And that person attempted to, I'm not even going to try to say that we did what the bank did, but we did some of it. And the point is, when the bank's looking at 5 different platforms to acquire, and these are all independent mortgage banks at the time, independent lenders, we were the one that was looking very favorable because we spoke their language. We talked about compliance. We talked about regulation. The other ones were all talking about just production volume. So that to us was a value that they saw, and they saw that we were not these renegades. We were actually speaking a little bit of their language. Due diligence got a lot of value out of having, just at the time, literally, it was a documentation room. So this is pre-electronic files. So I had files, I had everything copied, multiple copies put in folders. They would just go through an index and say, I want this, I want this, I want this, and boom, they'd pull them out. Somebody like myself, somebody who's done these deals before, can probably list out, 90% of the things people are going to ask for. And if you're prepared, it looks like you're organized. It looks like you're in control. And if you're scurrying around trying to get it, then you look out of control. So there's a valuation effect there. We had multiple bidders, and so we were entertaining them. We obviously had confidentiality, but we also had ways of letting them know that there's other people looking at it. So those kind of things went into getting a better bid, sharpening the pencil. Can we change more to cash, less on the earnout? Any risk? can you quantify the risk? So if you can quantify the risk, it's a lot easier for somebody to get their hands around it. I've got clients where what we've done is we insured the risk. So you've got this exposure that's, $20 million. So of course, as a buyer, you're going to say, well, I think it's going to be 20 million. And as a seller, I'm like, nobody knows anything about this. It's a contingency. It's not going to come to fruition. So we got a $20 million delta. I don't want that to be a purchase price adjustment, or I don't want that to be a holdback. What if I insure that? Maybe I can take that off the table so that you feel confident that let's just take that off the table. You don't even have to worry about it. I took out an insurance policy, whether I pay for it, you pay for it, we split it, whatever. That's just de-risk the transaction. I think that's a value add, So there's a lot of different things like that. I think most acquirers are going to look at people, both customers and employees. So do you have a concentration risk? Is there one customer that accounts for 40% of your sales? That would be a risk. How can you de-risk that? Get more customers would be one thing. Same thing with employees. They're going to want to know who does what are their responsibilities, how long they've been around, what's the stickiness of that employee? Are they on an employment agreement? What's your turnover? If your turnover is really high, they're just going to extrapolate that and say that, well, then there's a high probability that these key people are going to turn too. How are we going to prevent that? Let's sign them up under an employment agreement. If you can offer that, then that'll de-risk it.
So it sounds like it's not just the time. It looks like understanding who you're going to sell it to will dictate a lot of items here, because you're going to put yourself in their shoe, right? If it's a strategic buyer, what would they want to see? If it's a family member, or if it's one of the employees who will take over. So you would start to position things that would make it more appealing to that individual. And of course, whoever will fund it, right? As the
Right.
investors, they need to feel that there is a lower risk. In terms of multiples, I know it's by industry, and it's kind of also interesting subject, because just because one valuation says this, I guess strategic buyer would probably pay more than somebody who will take over as an employee, right? How would one go around the valuation? Is it industry, the brackets of EBITDA, or again, de-risking, right? If everything is, again, probably also too generic, right? Got to be specific case. So the valuation, like when I was just starting, I always thought that based on the deals that I was looking at, of course, they're all smaller deals, it seemed like anywhere between 1 to 3, 4 multiples. So what I found is if a company gets to be above million, and there is a management level in place and all this risk being diminished, the multiples start to go higher. And the higher you go in the EBITDA, the multiples start to climb as well. Investing into some kind of growth, it's not just an expense, because with that growth, you also pushing your multiples to be higher, right? So which is also kind of more attractive to the buyer. In your experience, was it always kind of straightforward, or it's so random that there is no structure to it?
Yeah, that's a question I get a lot. I think everybody wants to make it generic, but I think it's extremely unique. And there's a lot of different reasons why. You've got industry, you've got size, you could have number of employees, you could have just outliers. Like there's a transaction that was done and it happened to be by somebody who was an affinity partner of a company. And so they knew them really well. So there's a lot of different reasons. And I think a good private equity or venture back firm can give somebody the backdrop. And again, I would encourage your audience, if you're going to do a transaction or think about a transaction, get somebody involved early. The other thing I would point out is it's kind of like home sales, right? Everybody knows the prices of homes when they sell, but we always said what's more indicative is the listing prices. And the reason why is because that's telling you where the market's going. And so I think that's also a thing, because if you think about it, a transaction that closed today probably got inked 3 to 6 months earlier. And so that's not necessarily indicative of the transactions that are getting inked today. And so it's important to get that flavor. And I think most of your advisors can help you with that. And, so you have a time variable that goes on, because I ink a deal, it's going to close. Now there could be outs and so forth, but for the most part, it gets inked on a certain day. There could be adjustments based upon closing and all that, but that's not necessarily today's market. There's a whole host of things like we talked about. I have one company, 2 identical companies, and one has a concentration of owner selling the product. Okay. So that'd be like, if you're going to invest if you're going to buy a dental practice and it's one dentist, right? What's the value of that practice, right? It's really that dentist. And so if he's selling, there's really not a lot of value there. It'd be like a 1x. And when you have a high concentration, that's going to affect identical businesses, same production, same EBITDA and so forth. So I really think that it's a really unique item. I don't think averages are very misleading. You're going to have outliers on both ends and it can be very misleading. One of the things that you did say and mentioned, I think is a great point, is the impact on EBITDA. I've advised people a lot of times, the old saying, takes money to make money. And they look at the P&L and they start looking at something as, oh, well, that's only $1. Yeah, well, at 7X, it's really $7, right? So you got to think about what that impact is on your value, especially as you get closer and closer to that goal line, because I would much rather have that $7 than the $1. So I'll spend $1 to get $7. That sounds like a pretty good trade. And I think sometimes thinking about the valuation can be negative, but I think sometimes positive too, in the sense that you can encourage people that it's a good idea to make an investment. When I say investment, in your operations, going back to that example, we spent $50 a month in Coca-Cola. We got more value than $50. So.
Yeah, for sure. That first was brought to my attention by my coach. I was blown away by that, where revenue, focus on revenue. Let's get more sales. So let's go into marketing, bring more sales, revenue. No, there's bigger thing. There's profits, right? So profits, okay, let's focus on profits. But profits is not everything. You got to look at the capitalizations. What's the value, right? So when you look at the capitalization, you would care about your decisions on a completely different level when you see how it impacts the overall value of the company. Because when you exiting, that's where it has to be. So it's not just profits. Profits could be great, but if the risk level is crazy high because you're not de-risking it, right? Yeah, you have reached that point in profits, but now one of your customers is a government contract and they give you 80% of your business. Good luck selling that. It doesn't matter what you have, right? So like you said, the dentist, he could be making some good chunk of money at the end of the day because he's by himself. Maybe it's not like the margins are still healthy, everything looks good, but it doesn't mean it's a business, it's a job. He leaves, everything just stops, right? So yeah, when we focus on the capitalization, it's a completely different perspective, and decision-making changes as well. Do you want such a customer? What are you going to do to support that, and how it's impacting everything else that you have?
Awesome. Yeah, there's one saying I use a lot of times along those lines is sales cures all ills, right? You'll have companies, I've seen companies where they're extremely poorly operationally, but they have such good sales that nobody's focused on the problems, right? Because the sales mask it. And I've seen other companies where they're really good operationally, they don't have the sales. And so I'm like, if you could grow your sales, that's going to cure any of these minor issues that you have. And on the other side, it's like, well, you're masking all these big issues. We should focus on fixing these things. So I think you have to look at it multiple ways. I think top line growth obviously covers, if you have top line growth, at least you have something you can work with. If you don't have any top line growth, it's hard, right?
Yes.
You can't cut your way to success. So I think top line growth is great. I've got a couple of clients that are in businesses where here's a strategic idea, like they're selling their products, and their products they sell with a split. So basically the salespeople get a split of whatever the sales price is. And I've been working on them and advising them we're migrating that to a profit driven matter. Because with the split, what happens is the psychology and the salespeople start to think that they're operating their own little micro businesses because they're selling your product and they're getting a split. And you want them to be part of the whole, and they have to be focused not only on sales at all costs, but sales, to your point, profit perspective. So if I'm going to pay a salesperson, I want to look at more on a profit basis. So those are a couple takeaways. I think that gives you more value if you focus on that.
Yeah. So in reality, like you got to be that detailed too. And again, this is where CFO would come in very handy, right? You would want to look at everything as a separate profit center, right? I have a P&L for each salesperson. I have P&L for each location. I have P&L for overall, right? At the end of the day, you need to know what's impacting what on a bigger picture. Yeah, John, can you, I know there's so much still to talk about, but we're coming more towards the end. Can you share a little bit, maybe something that I didn't ask you that you would want the audience to know, and also a great time to share a little more about what you do and how you coming in to help. You simplify so many things for people, and at the end we'll also include how people can find you, so we can include it in the description below this video.
Sure. Thank you. One of the TV shows that I really enjoyed was Marcus Lemonis when he did The Prophet. And I think what he illustrated a lot to people, which I think most businesses should do, is he broke down the product or the service down to just show me this one item. Show me what goes into it. What's the cost that goes into this, and how much do you sell it for? And let's look at this on an individual product basis. Let's not look at this as how you're selling millions of dollars. Great, but we need to understand the components of this. And I think in my experience, that's really helpful, because if the owner can understand and truly understand what goes into it, like he always says, you got to know your numbers. So know your numbers, what goes into the product, and then obviously manage it, but you have to know it at first. I think that's a takeaway. And what I do, I do fractional CFO work primarily. I do some advisement on a coaching basis. So I coach some senior executives or owners of businesses where they don't have a board or things like that. I do serve on boards, but I would say 85% of my business is doing fractional CFO work. What that means, I think people should understand differences between a CPA, a tax advisor, an enrolled agent, a controller, CFO. CFO is usually more strategic. It's a role that's usually sitting at the leadership table. It's looking at the overall business. And as the things that we discussed just in this session, there's a wide range of things from vision, mission, and values down to what's the individual cost of a product. So as CFO, we kind of traverse through this whole continuum. And what I do is I come in and I try to make sense of those numbers for the entrepreneur. So it'd be like, okay, you have a controller, they get numbers. Controllers tend to be past focused. They try to get the information of what's happened last month. I want to focus you on what's going to happen next month, next year, 3 years. And how do we navigate that? Is there ways that we can change, things that we can change on that will get you to a different result? It's a lot different than looking back in the rearview mirror, but we do need that rearview mirror information to help us where we are today. And so it's that, I forget the actual name of the parable, but it's basically, you have to kind of know your present state, but you have to have confidence in your future vision and confronting the brutal facts of where you are. Let's look at the costs. Let's look at the revenue, and let's, maybe it's a different way of looking at it. A lot of times what I'll find is business owners don't know the difference between what's a cost of goods sold versus an operating expense. Sounds very minor and doesn't affect the bottom line, but it does affect it as you scale and grow, because a gross cost of goods sold is going to be a lot different than the operating. So anyway, those are the things we try to help them through. We also help them on structuring, try to help them figure out if they do get a deal to move forward. We usually advise on a lot of the work we do is on cap structure, trying to get people incentivized, try to help. We work a lot with their counsel. I'm a collaborative person by nature. So usually if they don't have somebody, I'll make recommendations on different specialists to bring in. And kind of what we talked about at the very beginning of the session is you need to use time to your advantage. And so the sooner you can get some people involved, I know it seems expensive to the business owner, but it's an investment. It's not an expense. And for example, as a fractional CFO, you get on my radar, we work together, and it's not a lot of time at the beginning. And as you start to see value, we can ramp it up. So you're kind of paying as you go, if you will, and it's providing you long-term value. So I think having professionals like myself help out. And again, I'm the first one to point out if I'm not the right person, but I think going it alone is not a good answer. You're running a business, and that business has to continue to run. And if you're going through a 3-month due diligence process, it's really easy for your business to fall off the rails if you're not focused on it. And it's hard to do both at the same time. I would encourage them to get people like myself to help them out. We're here to help. My pain is when I see somebody try to do it and fail. And my point to them is, what's the cost then of somebody like myself? If you just had a deal, a $20 million transaction that fell through because you weren't prepared for it, what was the cost of that? The $20 million? I can assure you I don't cost that much. And I think it's an investment, and I would really encourage people to do that.
Awesome. And it's not just strategic, it's strategic through leveraging numbers, right? So it's the opinion, leveraging the numbers, it's a completely different world. Is there a specific size of your ideal clients?
Great question. Most of mine are lower middle market. So I'd say most of my clients are in the $10 to $50 million revenue range. I do have obviously outliers on both sides, but that's usually my sweet spot. It tends to be people who aren't at the size where they have a full-time CFO, but they've got the issues that they really need to have advice from a CFO. And CFO is different than your CPA. Your CPA, I'm a CPA by background. I'm inactive, but I'm a CPA. It's just one of my pieces, my tools. But, CPAs typically, again, are validating information. They're looking at historical information. I'm not saying they can't do what I do, but generally speaking, they're usually looking at compliance with accounting regulations and so forth. I'm more on the, creative and perspective side.
Yeah, coming in also as an entrepreneur, you can relate. Not every CPA is entrepreneurial and can strategize on how to take the business to the next level. Plus,
That's
you
correct.
experienced multiple exits. Not every CPA is a part of it, unless they're part of like acquisition firm.
That's
Yeah,
right.
awesome. So, how would one be able to find you? What's your ideal?
So easiest way is they can catch me on my website. It's www.duHadwayLLC.com. That's duHadwayLLC.com. Email wise, they can reach me at John, JOHN, at duHadwayLLC.com. And my office number is 415-890-5200.
Got it. We'll include those below this video. John, thank you for all your insights. It was a pleasure. Thank you very much.
The pleasure was mine. Thank you so much. I really appreciate it.
Thank you.